Welcome to Accounting Principles 1B, the accounting equation. In video 1A, I discussed the accounting process, which includes analyzing transactions, recording, classifying, summarizing, reporting, and interpreting reports. This video explores how to analyze transactions using the accounting equation. The accounting equation is assets equals liabilities plus owner's equity. Note, this is an actual formula. Think of it as a simple math formula, such as 10 equals 2 plus 8, where 2 plus 8 equals 10. Thus, 10 equals 10. The same logic or formula applies with the accounting equation. Assets will always, without exception, equal the total of liabilities plus owner's equity. Let's look at some examples of the equation. If I have $10,000 in assets and $6,000 in liabilities, how much equity do I have? Well, the answer is $4,000, as 10,000 minus 6,000 equals 4,000. Another example, if I have 4,000 in liabilities and 8,000 in equity, how much assets do I have? 12,000 is correct. Here, 8,000 plus 4,000 equals 12,000. Lastly, another example is if I have $8,000 in assets and 5,000 in equity, how much liabilities do I have? 3,000 is the correct answer, as 8,000 minus 5,000 equals 3,000. It is very important to understand this equation and how it is interpreted, so let me define further what assets, equity, and liabilities are. Assets are items owned by a company, such as cash, supplies, inventory, equipment, cars, trucks, and buildings. Owner's equity represents how much of the assets the company actually owns or has rights to. For example, if when starting a company you invest $5,000 in cash and $10,000 in equipment, thus $15,000 in assets, you would have owner's equity of $15,000, meaning at any point I could sell the company and take back my $15,000 worth of assets. Note, another important term to understand is capital, which is the owner's investment of equity in the company. Liabilities include monies borrowed, typically to buy assets. For example, let's say you purchase $20,000 in computers from a local computer store. The store agreed that you don't have to pay them for 30 days. The local computer store is referred to as a creditor, as they are allowing you to take possession of something, in this case computers, without accepting cash, thus creating a liability or obligation to pay in the future. So again, in this circumstance, you are buying $20,000 in computers, but you are not paying with cash yet because you are going to pay in the future. So you are instead creating a liability. Another way to look at the accounting equation is to change it to show the importance of creditors by taking assets minus liabilities to equals equity. So let's say, for example, we have $30,000 of assets and $20,000 of liabilities, or money that we owe to creditors, how much equity would we have? $10,000. This means of the $30,000 in assets, if I were to sell the business, I would have to give $20,000 to creditors, which gives me $10,000 in equity, or assets, for myself. If we look at another example, let's say we have $30,000 in assets, no liabilities. How much equity would you have? 30,000 is correct. In this circumstance, we have no liabilities. Thus, we have no creditors, and the owner has the total rights to their assets. Join me in video 1C, where I can go through numerous example transactions with the accounting equation.